The Dividend Aristocrats have produced a 62% return over the past 5 years, along with dividend cash flow every 3 months. But you might be missing out on some of the best returns in these dividend stocks, the return before they get added to the list. Like when shares of General Dynamics jumped 42% the year before it was added to the Aristocrats in 2017, or the 20% bump in shares of NextEra before it regained the list in 2021. Or how about the 47% surge in shares of Pentair the year before it was added in 2013? And another 36% return that year. And unlike a lot of the other catalysts we watch for here on the channel for those short-term returns, this one is totally predictable. We know exactly which stocks could be added to the Dividend Aristocrats and when they will be added. I'll reveal the 7 future Dividend Aristocrats, along with why these stocks always get a pre-addition bump. The Dividend Aristocrats are the stocks in the S&P 500 index that not only pay a dividend, but have increased their payouts for at least 25 consecutive years. I like to use the ProShares S&P Aristocrats ETF, ticker NOBL, here as an example because it invests directly in these stocks. The fund adjusts each year, adding any new stocks that make it on the list and dropping those that couldn't make the cut. And it's got some great companies here like Clorox, Walmart, and Kimberly-Clark. The group pays a 2.4% dividend yield, which is 20% higher than the broader market average and is surprisingly well diversified across sectors. You can see here in the chart, it's a little heavily weighted to the consumer staples and industrials, but then has a solid mix in other sectors of the economy. And investors in the Aristocrats have done very well. This chart of the Dividend Aristocrats fund shows it's just keeping up with the stocks in the S&P 500, that broader stock market index, and even underperforming a little recently. But that price chart doesn't account for dividends. The 8.6% annualized price return on the Aristocrats becomes a market-beating 10.9% annual return when you include the dividends over the past 9 years. Here, I'm going to count up to the 7 dividend stocks that could be added, with 2 that could join the list in the next year. Nike, ticker NKE, with its 1.4% dividend yield, isn't a big payer, but has grown that dividend by about 9% a year over the last 5. The company usually raises its dividend for its December payment coming up. This will be Nike's 22nd consecutive year of dividend increases, putting it on track to join the Aristocrats within 3 years. The shares recently got a bump when the company beat earnings expectations by 27%, helped by cost-cutting and inventory restocking ahead of the fourth quarter. Sales are expected 3.8% higher this year and to accelerate 7.5% growth next year on just stronger international consumers. Now, Nike and these next 2 stocks may have a few years before being added to that Dividend Aristocrats list, but you might not want to wait that long to buy. Not only do these decades of consecutive dividend increases bring in more investors, but as they get closer to that list, hedge funds and other institutional investors start loading up to front-run those returns. That's because when a stock is added to the Aristocrats, other ETFs and institutional investors jump in to buy the stock. It's not just the Dividend Aristocrats fund that owns these stocks, but dozens of other funds target dividend growth stocks like these, ETFs with tens of billions to invest that must buy the shares when they pass some milestone, like that 25 years of increasing payments or just being added to a list like the Aristocrats. So a big part of the reason why these stock prices jump before being added to that list is the market knows demand for those shares is going to jump when they qualify, and all those ETFs and investors are going to start buying. Next on our list, Qualcomm, ticker QCOM, with its slightly higher 2.9% dividend yield, though the company has been slower to grow its dividend at just 5% annual pace over the last 5 years. But now you would expect a little slower dividend growth from a tech company because it's investing in that growth and it's come through in overall returns. Over the last 5 years, investors have returned an average 19% a year, including the dividend. Now, Qualcomm announced its 21st year of dividend increases this year in March, which still puts the Dividend Aristocrats list several years away, but this company is seeing strong growth in automotive and Internet of Things that could keep those shares running higher. Its automotive segment grew to nearly $500 million in sales last quarter, and the company expects self-driving to lead a massive demand for its chips. The IoT segment reached $1.5 billion and is expected to grow upwards of 30% a year through 2030. Qualcomm just announced a multi-year new agreement with Apple for its chip supply that clears up a lot of the fear and uncertainty in this stock. Mobile accounts for 73% of the company's revenue, and Qualcomm just locked in a 20% share of Apple's chipset supply for the 2026 smartphone launch. We can see valuation metrics here on Seeking Alpha, and shares are trading right now at just 12 times on a price-to-earnings basis. That is a 40% discount to the 5-year average, right around 19 times PE, so a good opportunity for the shares to move higher, just getting back to that average valuation. The pain in consumer staple stocks sets up an opportunity in Flour Foods, ticker FLO, with its 4.2% dividend yield. Dividend growth has been very strong here for a packaged foods company at 5% a year, and Flour Foods has paid a dividend since 1987. The company is a leader in the loaf, organic, and gluten-free bread brands and the second largest baked food companies in the United States. Flour's just announced its 21st year of consecutive dividend increases, raising the quarterly payout to 23 cents a share. Now, those higher interest rates are drawing yield-seeking investors out of safety stocks like Flour Foods and the consumer staples sector, but the stock is now very attractive on that valuation basis. Shares trade for under 10 times a price to earnings. That's half the average multiple over the last 5 years. We could see the stock nearly double just back to that average multiple. Now understand, this isn't the tech sector where we see double-digit growth, but sales are expected up 6.6% this year. It's a staple product that people are always going to buy, even in a recession. The company expects to leverage sales growth into long-term earnings growth of 7 to 9% a year. That will support dividend growth, and as we get closer to being added to the Aristocrats list, we could start seeing the price multiple come back up for those returns. We've still got 4 more future Dividend Aristocrats, but I also want to highlight a special offer from one of the research tools I use, Seeking Alpha Premium. I've used Premium Access for more than 7 years to get analysis and ideas, and more importantly, to make sure I'm getting the bull and bear case of a stock. You'll find pre-built stock screeners for top-rated stocks, dividend yields, and growth stocks. And you'll be able to sit in on a company's earnings report to get the inside information. Look for the link I'll leave in the description below, and you'll be able to try Premium Access risk-free for 7 days. If you like it, the link is also going to give you a promo code for $50 off the regular price, so make sure you check that out. I've highlighted Southern Copper, ticker SCCO, on the channel before with its solid 5.4% dividend yield. The company is on its 22nd year of dividend increases, with 20% annual growth in the payout over the last 5 years, and a 24% annualized return. Copper is one of my favorite plays on the rise of electric vehicles. While most investors are busy watching shares of Tesla and NIO for that electric revolution, the real opportunity could be in copper. On 2040 projections, the International Energy Agency estimates supplies of lithium, copper, and these other minerals is going to need to jump 30-fold to meet that demand. The average vehicle on the streets today holds just 51 pounds of copper, less than a third the amount needed for those battery electric vehicles, and just 2/3 the needed in a hybrid vehicle. Now, this chart shows the current and planned production for 3 key elements in those electric vehicles. Dark blue here is the current operating production, with light blue including planned projects. On that red line, the increased demand for electric vehicles, we could be in a supply deficit by 2024 in copper, and even earlier in some of these others. Now, Southern Copper has the highest copper reserves in the industry at over 67 million metric tons, and it's the world's 5th largest producer. In fact, on those reserves, the company has more than 50 years of production left in its mines. This is a focused producer with assets in Mexico and Peru, and more of a pure play on copper than some of these other miners, with an 84% of its revenue from the metal. I also like Freeport-McMoRan in this copper story, but Southern Copper pays a dividend yield more than 3 times that of FCX, and is the clear leader on those dividend increases. Now, this is a little lower yield at just 2.5%, but L3 Harris Technologies, ticker LHX, takes us back into those growth sectors. The aerospace and defense company is expected to post 12% revenue growth this year and to grow earnings by 9% to $13.40 a share. It's used that strong sales and earnings growth to increase the dividend by almost 11% a year over the last 5, and it announced in March the company's 22nd year of increases. So even though it's only paying 2.5% yield now, you know it's always going to keep growing that cash flow. I'll reveal the 2 dividend stocks that could join the Aristocrats within a year, but as strong as these returns could be, there is something to be said for stocks that get kicked off the list. In the video here, I'll highlight the 5 stocks fallen from the Aristocrats list and some surprising returns as they're reborn from the ashes. Fastenal, ticker FAST, with its 2.5% dividend, recently surprised the market with a big beat on its third quarter earnings. Shares jumped 8% as the company announced stable profitability margins and cash flow that jumped during the quarter. Fastenal has the fastest dividend growth in our list, increasing the payout by almost 12% a year over the last 5, and producing a 21% annual return on the shares. The company announced its 24th year of increasing its dividend, which puts it on the Dividend Aristocrats list within the next couple of years. Those industrial products the company sells are closely tied to the economy, and sales growth could take a hit during a recession, but Fastenal has the cash to continue that dividend growth and a history of returns for investors. The sub 1% dividend on shares of Casey's General Stores, ticker CASY, wouldn't normally put it on my watch list for dividend stocks, but there are reasons to like this one. What the stock lacks in yield makes up for it in returns, with a 17% annual return over the last 5 years and 8.2% annual dividend growth. Now, I grew up with Casey's in Iowa, and their taco pizza is legendary. It's the third largest convenience store chain in the United States, with over 2,500 locations, despite only being in 16 states. Besides increasing the dividend for 24 consecutive years, the company has also a solid share repurchase program, returning $400 million in cash to investors through that buyback. This isn't the fastest growing industry, but Casey's does it better than anyone else, and that translates to strong cash flow return and dividends for investors. Try out Seeking Alpha Premium risk-free for 7 days and get that $50 off promo code with the link in the description below. Or click on the video to the right for the 5 fallen aristocrats, stocks kicked off the Dividend Aristocrats list. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.